Good morning, everybody. Hope you all had a wonderful weekend. Welcome to the ARMR Virtual Hedge Fund experience. You guys are portfolio managers on the desk. You're joining me for the morning meeting. What we're going to do is go over macro, big picture risk monitor situations, how we're dealing with that kind of risk that we're taking, and the step-by-steps of when do we put more capital to work. When do we start buying individual stocks, making investments versus swing trades? All this kind of stuff I want to talk to you about today. So I'm going to share with you a chart of the S&P. I think is a must view. Okay, so we understand the magnitude of what's happening right now. We'll go over what the accelerant is that really drove the market last week. It's pretty obvious, and what it means for this rally. And at the end of the day, you have to remember, since you're the portfolio manager, you have to be the smart money. Figure out what your tolerance is from risk, what your goals are, type of portfolio you're running, and then just execute that strategy. So I'll share with you information about how I'm running my own personal capital. You figure out how it fits for you. All right. So first order of business, is the intense risk monitor green signal we had last week. We almost never get a signal that aggressive, but when we do, there is a significantly high probability that the market is beginning a new major rally leg, let's call it. Let's don't hide behind semantics of bull market or this, that, and the other thing. There's a major rally unfolding. All right, so now I'm going to walk you through what it looks like to me and why. I'm going to give you a picture of the S&P. And before I do it, I want to say a couple things. Number one, why am I sharing the significance of this with you? Well, for 2 years, it's been pretty much of a beat down in the stock market. Unless you own 7 stocks, it's been real difficult to make any money in the market. You have rallies that then fail. You have complete collapses in the market. You have sectors of the market that have been wiped out. So the last couple of years, you may be so beat up that when you start to see something real occur from an investment point of view, you just can't believe it. You can't see it. And so you come up with all the reasons why, no, this is going to be another fake out, head shake, market's going to collapse, and you end up missing, the correct entry point, and then you're constantly chasing the market on the way up, and it's almost impossible to outperform. So I want to try to save you that pain by sharing with you what the market looks like here, and going over the significance of the risk monitor behavior last week, which is to say all 10 ARMR algos for the 10 different ETFs that represent the different indexes, from bonds to growth stocks to, value stocks to momentum stocks. They all turned positive within a 24-hour window. This happens very infrequently. It happened in March 2009. Nobody believed it then. We thought the world was coming to an end. Why did it happen? Well, Ben Bernanke said, I'm just going to print money and buy everything in sight. Nobody really believed him at the time, except for, I guess people did, right? Everyone started putting money to work, and it started a major bull market, okay? But I remember when he first started talking about it, people were like, this isn't going to work. There was a huge rally in March. That's not real. That's going to reverse. That's just short covering, because there were big shorts that made money in 2008. That's just short covering, right? Sound familiar? Okay. It was the beginning of a major bull market. So what happened last week? I'm going to get into this, but before I do, I want to remind you of this. Everything I'm about to say, which you're going to think is wildly bullish, means nothing if the stops our hit on our swing strategies. And I'll come right on here and say to you, hey, we took a shot. That was the setup. Stops got hit. I'm back into cash. I have to reassess what's going on. That does happen. These are probability algorithms. Even if they're going to be right 90% of the time, means 10% of the time they won't. Means one trade out of 10 will reverse and hit the stops. Okay. Guess what? For us right now, because we executed right last week, our stop is break even. So worst case scenario, we break even, step out, reassess, maybe put the capital back to work in another couple of weeks. Who knows? So for us at the ARMR Report, for us at ARMR Investing Virtual Hedge Fund, we use day trading tools to get us long the market last week, which we turned into swing positions, and we're making money. Market reverses, goes back to break even, we step out. As long as that doesn't happen, I submit to you we're at the beginning of a major up leg in the market. I don't know how long it's going to last. I don't know how high it's going to go. That's not what the algos are about. We have to read and react to what we see. Okay, having said all that, let's get to why the market's doing this. Fundamentally, there was one comment last week when the Fed, Powell, had his presser. Okay, forget about all the other stuff he said. There's only one gem out of that meeting, and I shared it with you last week when we listened together. I said, "Did I just hear right? Did he just tell me that the Fed put is back on the market?" When answering a question, he looked right at the camera and said, we looked at the stock, I'm paraphrasing, we looked at the stock and bond market behavior and we decided not to raise rates. It was a part of our decision. For 2 years, that Fed put's been off the market. And every time somebody asks him that question during the meeting, he says, we're going to be higher for longer. We're afraid of inflation. Last week, he said, we looked at the stock and bond market and incorporated that into our decision not to raise rates. And what that did was create an unreal short covering route, because anybody short at that moment, and shorts are notorious cats on a hot tin roof. They have to be, otherwise they get destroyed, okay? They all looked at each other and said, holy smokes, the Fed puts back on the market. If that's the case, then the reward to risk scenario doesn't work anymore. The reward, which is the market collapse, is off the table. And the risk of the Fed doing supportive things is going to kill us. So we all have to cover our shorts. Don't believe me? All you have to do is look at this. Okay, take a look. There it is. Bearish bets backfire. This is Bloomberg. There it is. Traders betting on equities decline suffered largest losses as most shorted stocks rally. Okay, massive rally off of short covering. Let me tell you something else. All right, I'm going to read this to you. All right, that was the stock market. That was the stock market. But you know what? Here's the crazy statistic. Oh yeah, hedge funds had the biggest short positions on U.S. debt since 2006. That acts like accelerant to a risk monitor green signal. You're going to get regular investing put to work because the Fed says, hey, we looked at the markets and we made a decision to be supportive. And then you get the accelerant of short covering that makes this explosion higher. Now, I know what you're saying. You're saying, well, that accelerant will burn out and the market will come back down and this isn't real. I respectfully disagree with that. That accelerant is what starts the fire. The fire will consolidate and then continue to burn. That's usually what happens. Okay. If it hits the stop, I'll go to cash and we'll reassess. But as of right now, looking at the scenario, this is the beginning of a major run in the market. Not surprising It's Q4. Market tends to rally Q4. It's just a seasonality thing. Totally normal. So you're getting layer upon layer of what's normal, and the shorts are covering. Now that reminds me, you've heard me say on this desk, short covering is not for, you've heard me say on this desk, short selling is not for the average investor. It's not even for the above average investor. It's not for the individual investor. Now, we do it on our desk, and we made money over the last couple of months short selling. But I said to you while we were doing it, we're not going to hold these shorts for more than a day or two, because our primary goal is to get on the turn in the market. What we don't want to do is get blown up the week the market's skyrocketing short and then have to flip long, which is one of the most difficult things in the world to do. What we want to do, and I'm talking from experience, by the way, I've done this in the past. I've made a lot of money short, and last week I would have covered my short, making money, but missed the long entry point because it's so hard to flip long to short, from short to long. You cover your shorts, but you've just made so much money, you're sure the market's going lower. It's not, and you're always going to make more money on the long side of the market than you will short. It's just the way it is. The market goes up, 80% of the time. Okay? So A, if you're going to short, you have to do it quick, in and out, and not be greedy. And B, you have to always remember, what is your main focus? It's to get your investing capital to work at the beginning of the turn. Now let's look at technical analysis of the S&P. Here's another caveat for you, okay? Technical analysis, like beauty, is in the eye of the beholder. Let's don't get lost in your opinion or my opinion of what a cup and handle looks like and this, that, and the other thing, and reading textbooks. To me, if it walks like a duck, quacks like a duck, it's a duck. Okay? Not everything has to be perfect. I think this chart I'm going to show you is perfect, but I'm just preempting that, okay? Everybody has to take their own paintbrush when they're using technical analysis. Okay? This looks like an unbelievable cup and handle to me. And it's a little bit crazy when you look at what the cup and handle is on. Okay? It's on the S&P 500. This is 2022 April. There's the cup until July of 2023. That is a huge cup. There's the handle, which is a nice pullback, complete with, check it out, a double bottom shakeout below the key 200-day moving averages. The dark green line is exponential. The gray line is standard 200-day. That is an unbelievable cup and handle. Now, in theory, the cup and handle breakout is when you cross this top here, okay? So we're looking, what is that? 460. Take out 460, okay? And that's when the real breakout starts. But I don't wait for that. And quite frankly, nobody should. The reason why, one of the actually major reasons why I built an algo is because I got sick and tired of buying the breakout of the cup and handle. I wanted to buy the bottom of the handle. That's literally why, like going all the way back, I don't know how many, it's more than, I've been working on this for probably 20 years, writing different algos, from rudimentary algos to more, aggressive ones as more tools came to me, right? But even the basics, probably 20 years ago. And it started with the idea of, I'm sick and tired of buying the breakout that inevitably gets reversed for a while. And then you're like, what the heck's happening? And I want to buy the bottom of the handle. Why can't we do that? That is just exactly what happened on the entire S&P last week. We bought the bottom of the handle. So now let's go over how to build a portfolio using this information. This is the ARMR investing way, step by step, of how to build a portfolio. When you go from risk monitor red to risk monitor green, grab a pen, piece of paper, write this down, or you could read the captain's log, because I wrote it down for you in the captain's log. Step by step. This is the plan I'm executing. This may be frustrating to some of you on the live stream all day because I know you want me to go out there and buy individual stocks. But I submit to you that we are not at that stage yet. So I won't do it. Now, if you live in Europe and you can't buy ETFs, if you're an ARMR insider, can't buy ETFs, I get it. You've got to buy individual stocks. Feel free to DM me or ask me in the Slack room, and I'll tell you, I'll share with you what stocks I would buy to reflect the ETF that I'm buying. Okay? I'm happy to do that. But when it comes to all of our favorite names, all the ARMR power play names, all the names at the top of our whiteboard, it is just not the time to put the money to work yet. So this is the step-by-step approach. And here it is for you. We get the risk monitor green. The first thing we do is use day trading tools to get on a swing trade. We did that last week. We got long the S&P right after the Fed meeting when we heard those words and the market started to move and we had our classic day trading buy trigger. And we held those index positions overnight. Market gapped up the next day and we got another ARMR day trading setup. So we increased our index exposure. That was Thursday of last week. So by the end of the day, Thursday last week, we have somewhere between 50 to 100% of our index exposure in all the portfolios we run here. The more conservative portfolios, 50%, meaning we're catching half of the market move every day. My most aggressive portfolios, I have 100% exposure, meaning I'm catching whatever the market does, I'm making money. I have my index exposure. For our most aggressive portfolio, don't forget, where all we do is trade the S&P, and we use triple the S&P to do it, we're long SPXL from Wednesday last week, which means we're catching 300% upside. So we're having a huge run right now. That strategy follows a very tight stop program. So I expect it to get stopped out at some point, and we take that and go back to cash. But that's a different animal. Let's talk about portfolio structure of the average portfolio we're running. We're going to have somewhere between 50 and 100% of market behavior from here going forward. So we've got that piece on. The importance of that piece is to help you reduce the panic feeling that you're not keeping up with the market. Okay, get that out of your brain and your structure. I've seen time and again people run out when the market turns and they buy their favorite names, which go down because it has nothing to do with why the market's turning, and the market's going up and they're losing money, and you're just pulling your hair out. So the first thing you want to do is get your index exposure on. You're going to make money. You're going to make some money. Okay, now this week, so this is the next step. This week, which is the first week of Risk Monitor Green, is the most dangerous week for every new Risk Monitor signal. The Risk Monitor Greens that fail in the first week. You hear me say that over and over again. It's almost kind of obvious, but anyway. Okay, so this is the week of danger. This is why I won't have 10 to 15 individual stocks in my portfolio. The market reverses and craters in here. I can't defend that portfolio. There's too much slippage trying to get out of positions. It's very easy to defend an index-only portfolio right now. If I have to intraday, I'll go short the index and I'll just match off the position. Boom. I can cover like that. I can reduce my risk immediately. Right now, we're still in the phase of managing risk. It's not about maximizing gains right now. Not yet. Every new Risk Monitor Green signal will go through a shakeout to test. Could be this week, could be next week. I don't know when. The signal was so strong last week that our job now is to get ready. And when there's that weakness, could be a day or two, whatever, that comes down, It may test the stop. It might make a higher low. If the buy signal is strong enough, it never really comes down to the stop. It'll shake out in the morning, then rally a bit, shake out again, rally a bit, stay above, make a higher low. That would be ideal. And then there'll be another follow-through day of strength. And on that day, we maximize our portfolio exposure. You could do it different ways. You could just jack up your index exposure so you have 200% exposure, 150% exposure, whatever you want to create alpha of index exposure. And I may do that in my own personal portfolio. I may just have 200% exposure to the S&P and the NASDAQ from here to the end of the year. I may do that. I may add a component of the small caps, right? Because once the tax loss selling is over in small caps, they're going to have a wicked rally back. So I might get a little bit of that. So I might do some index things and give myself the risk I'm willing to take is increased exposure to indexes. I might not want individual stocks. I don't know. But that's our job right now. Step 1, day trade tools to get long the index. Step 2, ride the swing trade of the indexes. Earn the right to take more risk after the shakeout and test. If the shakeout and test holds, then you put more capital to work. And that'll be the moment where I put all the capital to work I want. Okay? And between now and then, we're going to work on building the top shelf list. What stocks do we want to own? Some names are going to get away from us. I don't care. You shouldn't care. We keep curating that list so that when we get the shakeout and then the reverse higher again, whatever names are at the top of that list that sync up with the market, those are the stocks that'll go in my portfolio. And I'll just end with this thought. Take a look at this chart. Let's just be very clear on this. Look right here. Okay. That's a gap up and that's a gap up. There are two gaps. There are two gaps in the market that have not been filled, meaning the market opened higher and then went higher. Two gaps that haven't been filled. Totally normal for those gaps to be filled, particularly on the S&P, big indexes. It doesn't always happen. And I go back to March 2009. It didn't happen then. It gapped and took off and never closed the gap. So it can do that. I'm not saying this is 2009. I mean, back then the Fed was buying things like crazy. Even in 2020, market gapped and never closed the gap because the Fed came out and said, we're buying everything in sight. And so institutions just went berserk. I don't know if what was said last week is strong enough to create a gap that doesn't get closed. I don't know. But I talk about those gaps to tell you that it would be totally normal for the gaps to close. And it's that type of weakness that we would look to buy. The gap would close, but hold above stops by the end of the day, reverse in the next day or two or whatever. And that's when we would add to our positions and fill out our individual stock exposure. So I look forward to working with you guys today. We'll keep working on our whiteboard. We'll go over, like we didn't do this for a while when the market was going down, but we're going to go over our O'Neill lists again, making sure we've got all of our favorite names. If we have to listen to conference calls, we will start doing research again. And when we get the turn, bang, we get that test and turn, we'll put the rest of our money to work. All right. I appreciate all the time you spend with me on the desk and listening to this conversation. It really helps me order my own thinking. I look forward to working with you guys live at 9:30. And remember, everybody, you're the smart money. Think for yourself, follow your strategy, and execute it. And you'll be successful. Have a great day, everybody.